This is Nightly Business Report with Tyler Matheson and Sue Herrera.
New risks, earnings are strong, the economy appears solid, but are new risks developing that investors need to watch?
Working overtime, the job market remains red hot, but is it on the verge of overheating?
Death of a car salesman? Why independent auto dealers face an uncertain future. Those stories and more tonight on Nightly Business Report for Wednesday, December 6th.
Good evening, everyone. Investors spent the day assessing the risks to the market, some new, some not. Well, first, there's the recent slide in technology shares, the same group that led the market higher this entire year. Some say the pullback is because of potential tax changes, and others say it could just be typical year-end selling. Add to that geopolitical risk. The president today made the controversial move of declaring Jerusalem to be the eternal capital of Israel, a dramatic shift from American foreign policy for the past few decades, sparking reaction from around the world. And that is where we begin tonight's broadcast. Eamon Javers is at the White House.
President Trump cast the decision to recognize Jerusalem as Israel's capital as simply acknowledging the reality politically on the ground in Jerusalem. He also said that he was fulfilling a campaign promise.
Today, I am delivering. I've judged this course of action to be in the best interests of the United States of America and the pursuit of peace between Israel and the Palestinians. This is a long overdue step to advance the peace process and to work towards a lasting agreement.
We're getting reaction from the region now, including this from Israeli Prime Minister Benjamin Netanyahu, who said there will be no change whatsoever to the status quo with the holy sites. Israel will always ensure the freedom of worship for Jews, Christians, and Muslims alike. President Trump, thank you for today's historic decision to recognize Jerusalem as Israel's capital. Meanwhile, the Palestinian President Abbas with this statement saying these reprehensible actions constitute a deliberate undermining of all peace efforts and represent a declaration that the United States has withdrawn from playing the role it has played in past decades in sponsoring the peace process. White House officials also said that it could take some time to move the U.S. Embassy from Tel Aviv, where it is now, to Jerusalem. Simply finding a location, building a facility, arranging for security, all of that could take years, they say. Nonetheless, the president is directing that process begin as soon as possible. For Nightly Business Report, I'm Eamon Javers at the White House.
And then there's tax reform. The details still have to be worked out, but major focus points for both individuals and companies is the alternative minimum tax. Ilan Mui tells us where things stand.
Republicans taking another step forward today on tax reform, with the Senate officially voting to go to conference with the House to hammer out a final version of their tax bill. One point of contention, the alternative minimum tax. Experts say that keeping it in the tax bill could undermine the benefits of lower rates, both for individuals and for businesses. And for households, those who would be most affected are married couples making between $300,000 and $750,000 a year. The Tax Policy Center estimates that if the alternative minimum tax is kept, their benefits could be dialed back by $8,000. Companies are also fighting hard to make sure that the tax doesn't remain in the final version of any legislation. They're saying that the problem is that the corporate rate is now 20% in the Senate version of the bill, as well as the rate imposed by the alternative minimum tax. So that means if companies try to take advantage of benefits like repatriating foreign earnings or using the popular credit for research and development, their effective tax rate would fall below 20%, forcing that alternative tax to kick in and putting them back at a 20% rate. So that means companies are essentially being penalized for doing what lawmakers are trying to incentivize them to do. Republicans acknowledge that this is a problem. They say they want to work this out in conference committee. Senate Finance Committee Chairman Orrin Hatch was asked by reporters today if it might be included in the final version of any bill. He said, "It doesn't look like it for now, but you never know." For Nightly Business Report, I'm Ilan Mui in Washington.
And there are late-day reports that a 22% corporate tax rate is still under consideration because it would help pay for other provisions.
Citigroup giving some guidance on how the proposed tax bill could impact its bottom line. Citi's CFO said the bank would likely take a hit of $20 billion. Most of that, a one-time hit, would be a write-down of its deferred tax asset. But over the longer term, the plan is expected to significantly lower the tax rates that banks pay, and that could lift profits.
There is also a slim risk of a government shutdown, though House Republicans today advanced legislation that extends government funding through December 22nd. But the president said a shutdown could happen this weekend. He added that if it does, it would be because Democrats held up spending negotiations. The top House Democrat, Nancy Pelosi, said the only person talking about a shutdown is the president.
Let's turn now to Art Hogan for more on the risks to the market. He's chief market strategist at B. Riley FBR. Art, good as always to see you. How do you look at the risks, including, why don't we start with the new one that came in today, and that is the declaration by the president that the United States will recognize Jerusalem as the capital of Israel. How do you put these all into the stew and decide which ones to worry about less, or not worry about at all?
Yeah, that's a great question. And the problem with that is in all geopolitical hotspots, it's impossible to model. And it's impossible to really react as a market until something turns economic versus something that turns from a geopolitical hotspot into an escalation that becomes a military event. So we've been working with this with North Korea for the past 6 months. You know, they launch a missile, they test another missile, the market tries to adjust to that, but it's just impossible to model that in. It's certainly worked its way to the front burner in terms of clear and present danger and one of our concerns for the marketplace, but you won't see the market trying to adjust to that until it escalates to a level of military action. And I think that's true of North Korea as well.
What about the debate on Capitol Hill with the possible government shutdown and tax reform? Now, obviously, they're still trying to work it all out, but how big a risk might some of those details be for the market?
Well, I think the government shutdown is a movie that we've seen before. There's a lot of job boning that goes on and negotiating, and at the end of the day, we come to a resolve. It's usually at the 11th hour. So I think that's probably less of a concern. I think the tax plan right now prevents a pretty symmetric risk to the market right now. By that, I mean we've priced in some modicum of success. A failure in the tax plan, or at least pushing it off into 2018, probably means we have about a 5 to 8% pullback. If it succeeds, we probably have a 5 to 8% run up in the market. So we're asymmetrical. I mean, we're very symmetrical in our risks around taxes right now.
Is technology really rolling over?
No, it's not. It's three things, right? So you want to lock in your winners. Technology's clearly been the winner. When you look at just the FANG names themselves, they're up, somewhere between 35 and 40% on a year-to-date basis. It makes sense. There are some provisions in the tax bill, especially if the corporate AMT stays in there, that would be negative for them, but it would have a negative impact on what we'd like those corporations to do: research and development, repatriation of capital. So I think we're going to work around that. But it's that end of the year, if you're going to take profits, you take them where they are, and if you're going to rotate into some of the value names, which we've seen a lot of both in financials and energy and industrials and some of the retail names, the technology is being used as a source of funds, right? So it's almost like it's a source of funds to make that rotation. I think that rotation is coming to its end. We probably won't be talking about this next week.
Art Hogan, always good to see you, the man with more logos behind him than anybody I've ever seen. B. Riley, FBR, Wunderlich. Take your pick. Art Hogan, always good to see you.
Thanks so much.
You bet.
Well, on Wall Street, investors appeared to be in watch and wait mode. The Dow Jones Industrial Average slid 39 points to 24,140. The Nasdaq was up 14, and the S&P 500 was off a fraction, falling for 4 straight sessions.
The job market has been a hot part of the economy. A new report today shows that hiring was solid last month, reflecting a job market that's firing on all cylinders. But could it get too hot? Steve Leisman takes a look.
Job growth looks to have stayed strong in November as markets ready for the employment report coming this Friday. Economists estimate 195,000 jobs were created in November, and the unemployment rate remained at a 17-year low of 4.1%. Backing up the call, the private payroll company ADP, which uses its own data to forecast national job growth, came in solid at 190,000 for November. Some economists, though, are worried that the economy could be on the verge of overheating because it can't sustain this much employment without creating inflation.
At the current rate of job growth, close to 200,000 per month, that's more than double the rate of growth in the labor force. So unemployment, underemployment continue to decline. And the unemployment rate is 4.1. We're going sub 4% by this time next year, and that's an economy that could overheat.
ADP found job strength in education and health services along with manufacturing. Trade and transport jobs surged by 36,000. That's a big seasonal factor as retailers staff up their warehouses for the holidays and struggle to find truck drivers to deliver all those packages. If these strong job numbers continue, it could prompt the Fed to move a bit faster in raising rates, especially if there are signs of inflation along with it. For Nightly Business Report, I'm Steve Leisman.
Out in California, officials say insurance claims for the October wildfires that ravaged the northern part of that state have reached $9 billion. And today, state officials are dealing with another dangerous fire further south in the Bel Air area of Los Angeles. Jane Wells is there.
I'm on top of Mulholland here to give you an idea of just how much smoke is blanketing the nation's second largest city. Behind me here is the newest fire, which broke out this morning. You could see from aerial pictures of it, this fire in Bel Air has forced the evacuation of one of the most exclusive neighborhoods in Los Angeles. At least 4 homes destroyed. That number is expected to go up. And it really ruined a commute in one of the busiest freeways in the country. We have cell phone videos. The 405 freeway in the Sepulveda Pass, a major thoroughfare, was shut down this morning by the fire. Hundreds of people were trapped before they could get out of it. It really just destroyed the morning commute. But there are 5 active fires across Southern California right now, burning at least 77,000 acres. At least 185 homes have been destroyed. That number is expected to go way up, and tens of thousands of people have been evacuated. 4 of the 5 fires at last check had 0% containment. If you come back, you can see me that it's not too windy right now. You can tell by my hair. The wind is expected to kick way back up tonight, last through the weekend in what is one of the longest Santa Ana events we've had here. And I just want to do a 180 and show you exactly what we're talking about. I had LA behind me, the city. This is the San Fernando Valley. This is another fire which starts off to the right, the Creek Fire. 11,000 acres at least burned, 30 homes at least destroyed. And if you pan to the left, you can just see the smoke from that fire fanning out across the San Fernando Valley, meeting up with smoke from another fire in Santa Clarita over the hills, and going far to the left here into the west to meet the largest fire out in Ventura County, the Thomas Fire, 65,000 acres, well over 150 homes destroyed, thousands displaced, no power, schools closed, air quality terrible. We're going to have to see how this plays out for the rest of the week. For a Nightly Business Report, I'm Jane Wells in Bel Air.
And still ahead, why UPS is already suffering from some holiday headaches. As Republicans hash out the final version of the tax bill, housing advocates say it could hurt both home prices and home ownership rates. But a top housing expert doesn't necessarily agree, and Diana Olick spoke to him.
If anyone knows home prices, it's Professor Robert Shiller, co-creator of the much-watched S&P Case-Shiller Home Price Index. The index, which dates back to 1988, revolutionized how the housing market measures moves in prices. Shiller says a cut to the mortgage interest deduction would not hurt prices.
But the general idea is that it would push prices down if people are rational.
But you're saying if people are rational. Now, the question is, do we use the mortgage interest deduction as our major incentive to buy a home? No.
Most people don't itemize. So it's not big.
Shiller did, however, think that a cut to the property tax deduction would have some impact, if only to rich people.
That is going to be a substantial hit to people who are paying a lot of property taxes. And it might be a consideration that you make before you buy this big mansion in some high property tax state.
Shiller also had a surprising view of rising mortgage rates.
I tend to think it's not as great as you imagine, because people are people, and I don't find that historically home prices have relied at all predictably to changes in things like interest rates.
In other words, people are not always rational, especially when it comes to their biggest and most emotional investment, their home. For Nightly Business Report, I'm Diana Olick in Washington.
Susan Wachter joins us now to talk about how the tax bill might impact the housing market and you, of course. She's a professor of real estate and finance at the University of Pennsylvania's Wharton School of Business. Welcome back, Susan. Nice to see you again.
My pleasure.
Let me get you to react a little bit to what Professor Schiller said in Diana Olick's piece, because we're located in New Jersey and property taxes are high. And that's regardless of whether you buy a big home or not. They simply are higher than other parts of the country. What did you make of his take on how much the property tax deduction or the loss of that deduction would hurt home values?
Well, let me just generally say, not to differ with my friend Bob too much, but I think there are enough rational people out there that all three of these potential changes will affect the housing market, and not in a good way. There's no question about it that at the high end, high property tax states and high price states will take a hit.
That would be my impression living in a high property tax state such as I do, because it makes the relative ability, the cash flow equation changes. And similarly, when one looks at a mortgage write-off, you look at the after-tax cost of home ownership. Both of these things will raise that. Right?
And it's not just the home ownership choice, absolutely, but it's not just the home ownership, it's the choice of how expensive a home. And
Correct.
How expensive a home is going to be more costly and significantly more costly for those who are in the high tax brackets and cannot deduct anymore a $1 million home, which in many markets, high-priced markets, is not out of the ordinary. It's quite ordinary in New Jersey and California. These markets are going to be hit by the $500,000 limit in the House. No limit, stay with $1 million in the Senate, so lots of moving pieces here. And at the same time, though, if that stays, the $500,000 limit in the House, and we have the property tax $10,000 limit, that's a double hit for high price and high tax states.
Now, all real estate is local, of course, and it will differ depending on what state a person lives in and decides to buy a home in. But as they work out these details, can you quantify how much of a hit it might be on the overall housing market, or is it too soon to tell? But you see,
well, it's too soon, but for a lot of moving pieces. But more than that, it's very local. So it always is local with housing prices, but even more so. It's not just local, but it's hyper-local in a sense, because it's going to be the concentration of high-priced homes in some neighborhoods, together with the high taxes. Those neighborhoods will be taking the hit, and others may not. So it may not be noticeable in the Case-Shiller Index, for example, but it sure will be noticeable to some.
All right, Susan, thank you very much. We may be moving to Pennsylvania. Thanks, Susan. We appreciate it.
You're welcome. Love to have you.
Susan Wachter with the University of Pennsylvania's Wharton School of Business.
United Health expands its reach, and that is where we begin tonight's market focus. United Health will buy the kidney care company DaVita for just under $5 billion, adding more than 300 clinics and urgent care centers in several states. United Health shares off a fraction. To $19.94, DaVita took off. They were up more than 13%. Shares there at $69.20. Madrigal Pharmaceuticals said its experimental drug for treating a chronic liver disease that could lead to liver failure or cancer performed well during a study. The drug maker said the treatment caused a significant reduction in liver fat when compared to the placebo. Shares of the biotech company skyrocketed 88% to $87.18. Speaking of taxes, H&R Block reported stronger than expected revenue gains in what is usually a slow quarter for the tax preparer. The company's loss was also smaller than analysts expected. Shares of H&R popped 10% to $28.99.
Brown-Forman said strong sales of Jack Daniel's whiskey and tequila helped overall revenue rise. The company said demand was solid in the U.S. and abroad, and it's raising its full-year earnings forecast. Shares climbed 6% to close the day at $65.85. Walmart is changing its official name in an effort to shift away from its brick-and-mortar image. The nation's largest retailer is dropping the hyphen and the word stores in its corporate name to bring attention to the importance of its e-commerce business. Walmart shares fell fractionally to $97.28. Morgan Stanley says Amazon is a threat to dental suppliers Henry Schein and Patterson. Analysts at the bank downgraded shares of both companies, citing Amazon's entry into the dental supply market. The note says the e-commerce giant has been buying supplies directly from another manufacturer and could develop similar business relationships in the future. Shares of Henry Schein fell nearly 5% to $67.58. Patterson shares were down 4% to $34.81. And Home Depot is launching a $15 billion share buyback program. The nation's largest home improvement chain laid out its financial goals, saying it expects total sales in fiscal 2020 to reach nearly $120 billion. The company also said it plans to ramp up investments in technology and services. Home Depot shares finished the day down 1% to $180.80.
Package delivery delays already. That's what UPS says is happening, and it is working to fix the problem and get back on schedule. Morgan Brennan reports.
The good news, online holiday shopping is shaping up to be strong. The bad news, that's already causing some delivery headaches. UPS experiencing some service snags as a surge of packages floods its network. Those, quote, unprecedented shipping volumes causing the company to add up to 2 days of time in transit on some deliveries. To counter, it has shifted more employees and resources to the busiest markets and expects the issue to be resolved by tomorrow. It speaks to the high stakes of the month-long peak season, when shipping giants UPS and FedEx handle staggering volumes under tight deadlines.
The issue with peak volumes is you don't know where the volumes are going to pop up. They might be correct in predicting that they're going to have a 10% or 20% increase on a certain day, but they're just not sure if that's going to come necessarily in Pittsburgh, Chicago, Phoenix, Seattle, or Miami.
UPS expects to deliver 750 million packages this holiday season. FedEx anticipates up to 400 million. The challenge, predicting where the spikes in volume will occur. For the week of Cyber Monday, third-party service tracker ShipMatrix says FedEx had a better record of delivering packages on time than UPS. Neither is commenting on that data, but FedEx does say it's, quote, proud of its service so far and that the company is well positioned to meet anticipated record demand. And with 18 days until Christmas, it is still early, especially since both companies have spent billions to bring on extra workers, more sorting space, and new planes. Preparation that's taken all year just to be able to handle the holiday rush. For Nightly Business Report, I'm Morgan Brennan.
Coming up, why your neighborhood car dealer may be thinking about closing up shop.
Bitcoin today broke above 13,000 less than 24 hours after topping 12,000. The digital currency now has a market value in total of more than $200 billion, more than twice that of Goldman Sachs. But it's that value that has the former chair of the Federal Reserve scratching his head.
Bitcoin is really a fascinating example of how human beings create value or estimate or judge value. And it's not always rational. You cannot tell me that you can create out of nothing something which has a medium of exchange value. It is not a rational currency in that sense. But that does not mean it will not trade, because so long as people believe they can sell it to somebody else or unload it on somebody else, that's all you need to create a market.
Greenspan also compared Bitcoin to colonial American currency that eventually became worthless.
After decades of selling millions of cars and trucks, local independent auto dealers are wondering about the future of their industry. Car sharing, autonomous drive vehicles, and other new technologies have some dealers saying it's time to get out of the business. Here's Phil LeBeau.
After 62 years of selling cars in Southern California, Daryl Holter's family is shifting gears. They recently sold some of their dealerships despite near record high auto sales. Why? Holter thinks auto dealers may not sell or service as many vehicles as rideshare companies and autonomous drive vehicles become more popular.
I think the customers, will want to go in this direction, and I think that it will move us away from being full-service automotive providers from start to finish.
There are more than 18,000 auto dealerships in the United States, with more than half of them owned by families or small private companies. For years, they've made healthy profits, primarily by servicing cars and trucks. But a firm that tracks the industry is seeing more independent auto dealers wondering if the future will be as profitable as cars and transportation services evolve.
More and more dealers are saying, well, at those levels, it probably is time to exit rather than roll the dice for the next generation and have them have to handle potentially a lot of changes in the future.
While large publicly traded dealership chains have added more stores in recent years, independent dealers like Mark Scarpelli in Antioch, Illinois, believe mom and pop dealerships will not go away and are ready to change with the times.
We talk about autonomous cars, electrification, fossil fuels, all of those things, interest rates. So we're kind of into our market, we know, and we're looking forward.
Another factor that could be leading some longtime owners to sell their dealerships is the fact that the price of an auto dealership right now is at an all-time high. On average, they're selling for just under $17 million. Phil LeBeau, Nightly Business Report, Chicago.
I had no idea.
$17 million.
Wow. Wow. That does it for us tonight. I'm Sue Herrera. Thanks for watching.
And thanks from me as well. Have a great evening, everybody. We'll see you back here for NBR tomorrow.